The world doesn't trust our treasury market anymore because of fiscal irresponsibility and sanctions like we did to Russia. And Trump saying a 500% tariff if you support Russian energy purchases. Well, that's not a tariff, that's a sanction. They don't trust us. The banks don't trust each other. And now the exchanges, the players within the biggest exchanges on the planet don't trust each other to the point where they say, nah, I'm going to pay more for it right now than I will for it in the future. That is backwardation. That, again, the theme is no one trusts each other. And that's a problem in a world where everything is based upon trust. It is a lack of trust across the board, and that is not what strong economies and resiliency is born from.
The last year has exposed more than just inflation and policy mistakes. It has exposed a structural erosion of trust that underpins modern finance. When counterparties stop lending to one another overnight, when exchanges and clearinghouses begin to price immediate delivery above forward contracts, what we are seeing is not simply a temporary liquidity hiccup. It is a crisis of confidence inside the plumbing of the system itself. That lack of trust touches everything from sovereign debt markets to the overnight repo markets, and it changes how the best-informed institutions think about risk, collateral, and the very definition of safe assets. Andy Schectman has been sounding the alarm about exactly this problem: the diminishing faith in the institutions, instruments, and legal frameworks that have long supported global markets. In a recent interview, he frames recent repo injections, the unusual behavior in futures spreads, and the increasingly visible fractures inside major exchanges as symptoms of a deeper breakdown. The trading community no longer treats paper promises as equivalent to physical deliverables. For precious metals investors, the stakes are enormous because gold and silver occupy a unique role as both monetary history and physical scarcity. Unlike a sovereign bond or a derivative, bullion and physical metal are not an accounting entry that can be rehypothecated away without someone having to deliver the metal itself. That difference matters now more than ever. When trust frays, markets migrate toward assets whose value does not depend on the honesty of a counterparty or the solvency of a ledger entry. This structural tailwind for physical gold and silver is therefore not a coincidence. It is a rational capital reallocation driven by a crisis of faith. The story is not merely defensive. The breakdown of trust creates both urgency and opportunity. Urgency because backwardation and delivery pressures can accelerate price discovery in a short window. Opportunity because early capital that recognizes these signals gets exposure to an asymmetric payoff: physical metal that cannot be created by a central bank's promise. This is the core thesis you'll hear threaded through Andy's analysis. The financial system's credibility is the variable that determines whether paper continues to dominate or whether physical, verifiable assets reclaim their central place in portfolios. If you find this kind of deep dive analysis valuable, please subscribe to the channel, like this video, turn on notifications, and share this video with others who need to hear it. We appreciate the support and hope you enjoy the video.
Something is happening in my mind beneath the surface of the financial system because over a 5-day stretch over the last 2 weeks, the Federal Reserve injected $125 billion into the repo market, and the popular talking heads would say it was to ease funding stress, as we saw in 2019 with the repo market problems, in 2008 with the fail of Lehman Brothers and the great financial crisis. But it's important to understand that $125 billion, especially over a few days, over a period of 5 days, is akin to crisis-like behavior. It's on par with what we saw when Lehman fell. It's on par to the 2019 blowout in the repo market. But let's first kind of try and dumb down what the repo market is. It's the plumbing of the financial system. And it's where banks, big banks, lend to each other overnight, literally overnight. And they do this to keep things flowing, if you will. Normally, this market, you never hear about it, and that's what it's supposed to be. It's quiet. It means everything's working. But when the Fed steps in with huge amounts of cash, mind you, typically, if there's no stress, you won't see much of any movement in the repo market or usage of it. If there's a little bit of stress, you might see $3, $4, $5 billion put into it, or trading in it. If there's moderate stress, maybe 10, 12 billion. At 125 billion, it's the equivalent of hearing loud banging noise every time you turn your water on in the walls. Something's not right. Something's not flowing right. But what makes this concerning and very different than what we saw in 2008 and 2019 is that in 2008 and 2019, it was an issue of liquidity or lack thereof. Now, this is not a we're out of money problem. Today, the big banks that would trade in the repo market actually have twice the reserves that they had during the 2019 repo crisis. And in this environment, the Fed would rarely, if ever, inject liquidity into the overnight market when reserves are this high. In this environment, repo injection should be near zero because the banks have enough money to trade with one another back and forth. It's just overnight exchanging collateral, typically treasuries, sometimes mortgage-backed securities or whatnot. But this isn't about money. It's about trust or lack thereof. And in essence, then again, banks are looking at each other and saying, not a chance in the world am I going to borrow anything or lend anything to you, or not even for one night. And because I'm not sure you're going to pay me back tomorrow morning. And the reason this matters is because you typically only see repo market stress right before market corrections. It's an ominous sign in that this is all about the lack of trust. And when the most well-informed traders on the planet, the very, very large commercial banks, are saying, you know what, I'm not lending my money into this system. I'll just park it at the Fed instead. I am not going to do it. And you start to see the overnight lending system dry up. It portrays, I think, serious fractures within the entire system and is far more concerning than just a lack of liquidity. It's a lack of trust, which is far more systemic and troubling. The banks are trading with other banks, smaller, regional maybe, and also with large hedge funds. And even though you would think that this would be something that should be easy peasy, it's not. And because now it's a lack of trust, it's also a lack of faith in collateral. We've been seeing a lot of subprime and mortgage-backed securities, not subprime, but mortgage-backed securities rather, used as collateral. Now, you would do that after you've already, you're doing that because you don't have treasuries or you don't want to trade your treasuries. You're trying to give the collateral that is less than perfect, so they don't trust the collateral and or they don't trust the partners. That is not a good thing because you're trading overnight. You're talking the most liquid, safe, secure trading platform on the planet. You can't get more conservative than trading overnight with the big banks and using a collateral that is, either mortgage-backed securities, which are bundled, or treasuries. And this portrays that the system itself is rotting from underneath. And the big players know this. It's concerning for sure. And I think people should keep a close eye on it. If this was a problem of lack of liquidity, it would be less concerning to me than a lack of trust. Trust is a hard thing to get back, and the people at the top see the picture better than anybody. They understand exactly just what kind of clothing the emperor is wearing, I guess you could say. And for them to not trade in what is the most conservative, easy trade you'll ever find overnight because they don't trust the system, it's an indictment not just of the trading partners, but of the liquidity or the solvency of the trading partners and also the value of the collateral. And I think these are two very, very dangerous topics when you talk about what it means. It means that the Fed will typically in this environment be forced to come in and intervene whether they want to or not. And when you already have inflation running much higher than the CPI tells us, we can all feel it with the grocery bills and all of our other bills and our paycheck not going as far. It could really be if you will, the match that lights the fuse, not only to inflation, but the systemic problems that could chain, domino all the way down if they don't step in. So yeah, it's something people should really, really pay close attention to. And if the banks don't want to lend money to other banks, what does it say about keeping your money within a banking system? What does it say about the systemic risks within the banking system itself? I think people should think about that as well. This is one of the things that we've talked about a lot on your show, is just how safe is the banking system with the change to Universal Commercial Code, with the great taking by David Rogers Webb, with being an unsecured general creditor over the FDIC limit. All of these things we've talked about, bail-ins versus bailouts, for a long time, this is how it would start. In essence, this is where the trouble starts before the stocks get wind of it, before the credit markets get wind of it, before the media gets wind of it. It starts right here because you're talking the most well-informed traders on the planet that are making these decisions.
Picking up from Andy Schectman's analysis, the repo injections and the dry-up of overnight lending are not neutral statistics. They are a behavioral index. When large banks prefer to park funds at the Fed rather than lend to other highly rated banks overnight, the market is revealing a premium on counterparty certainty that cannot be priced away by higher short-term rates alone. That premium has consequences. Collateral that used to be treated as equivalent, treasuries, high-quality MBS, commercial paper, is now discriminated against, rehypothecated less freely, and sometimes replaced by imperfect collateral. Those shifts change the velocity of capital, increase funding costs under stress, and make the delivery mechanics of physical markets materially more relevant. Translate that into the metals complex, and the mechanism becomes clearer. Backwardation, narrow spot to future spreads near delivery, and persistent demand for immediate allocation are discrete indicators that physical supply-demand dynamics matter again. When futures markets stop being mere paper bets and begin to reflect an unwillingness to defer receipt of metal, you are witnessing a market where the optionality of paper contracts is being discounted in favor of the certainty of physical possession. That is precisely what drives a structural revaluation. Holders who can actually take delivery, refineries, ETFs with allocated metal, sovereign buyers, are effectively buying insurance against a systemic failure of trust in the financial plumbing.
So I think we're either 9 or 10 days away from where holders of the December gold and silver contracts have to, it goes into delivery at that point. I think it's the 28th of November. This is where you could say instead of the rubber meets the road, it's where paper meets physical. Those who want to stand for delivery can on the 28th. They don't have to do it on the 28th, but this is when typically they'll declare, yes, we're going to stand for delivery. And when you look at gold right now, it's business as usual. You have spot right now. I looked this morning. It was like $1.60, I think, over the December futures contract. And that is classic contango, right? And so you have the futures price is going to be and it's actually under the December futures contract. Spot is about $1.60 under the December futures contract, which is classic contango, which means the further out you go, you're supposed to pay a higher price, and that takes into account things like storage, interest expense, the cost of money. So in other words, if the spot was 4,100 an ounce, it would be 4101.50, something like that for the December futures contract. As we get much closer to the end of the contract, when you can stand for delivery, it should get narrow and narrow and narrow and get closer to 1-to-1. The further out you go, the larger that contango, the larger that interest expense, the larger the cost of storage. That's normally how it works. So if you go a year out, it may be $25 an ounce more because of the cost of money, the cost of interest, and the people who are betting on it says, yeah, it's going to be $25 higher in a year. That's contango. Backwardation is something you don't see in the metals market very often. It's where the spot price is over the futures price, not under like gold and contango and normal market, but over. And that's backwardation. And it's rare, especially this close to expiration. What it basically says is someone wants physical silver now, not later, and that they see tightness in inventories and immediate demand is outpacing the expected supply. In other words, I don't care what the futures say. I will pay more for it today. I don't want to give you, kind of like what the banks are saying. I don't want to wait one day. I don't want to wait any time at all. I want it right now. And this kind of spread, especially as we get close to expiration, doesn't happen unless something's off. And it usually comes right before a big move in the metals market. So I think it's interesting to see, this is what we've been talking about for a long time. Now, for a minute, we saw the market when 50 plus million ounces found their way to London. We saw the market shift from big backwardation as much as $3 an ounce to contango, as it's supposed to be, lasted not more than a day or two, if that. And now all of a sudden we're back in backwardation again. And that just simply says a lack of trust. And this is a theme we see everywhere, whether it be the leaving or the dumping of treasuries by countries like Japan, who has its own problem right now with the $110 billion stimulus package that they're throwing out because the yen is collapsing to a 35-year low. But you're seeing it with, the world doesn't trust our treasury market anymore because of fiscal irresponsibility and sanctions like we did to Russia. And Trump saying a 500% tariff if you support Russian energy purchases. Well, that's not a tariff, that's a sanction. They don't trust us. The banks don't trust each other. And now the exchanges, the players within the biggest exchanges on the planet don't trust each other to the point where they say, nah, I'm going to pay more for it right now than I will for it in the future. That is backwardation. That, again, the theme is no one trusts each other. And that's a problem in a world where everything is based upon trust. And if the trust is eroded, if your wife cheats on you, how long does it take for you, if ever, to get that trust back? Now, that's a bad analogy, but the point is the same. We are a country, we're the good guys. We were based on, a moral high ground and doing the right thing. And you could argue whether it be the constant political bickering, whether it be, the way the world looks at us being in Iraq, yet passing judgment for 22 years, mind you. We're still there. We never found the weapons, but the way we passed judgment on Russia. Now, I'm not making making a statement on either, but I'm just saying the world looks at us as being hypocritical. And the treasury market based on trust with massive fiscal irresponsibility and countries wondering if they're going to be the next one to be sanctioned, everything seems to be eroding in terms of trust. When trust in institution, in currency, in the judicial system, even all the way up to the Supreme Court. Look at what's happening on the Federal Reserve. We don't trust them anymore either. We're finding the members of the Federal Reserve are doing illegal things that we would go to jail for, but they just get fired from the Federal Reserve. It is a lack of trust across the board, and that is not what strong economies and resiliency is born from. In fact, quite to the contrary, to me, it is far more discouraging and threatening to this system than just about anything else.
There are several dynamics to weigh carefully. First, delivery mechanics matter. Contract roll dates, warehouse inventories, and exchange settlement practices are no longer operational footnotes. They are strategic points of leverage. As Andy highlights, imminent delivery windows concentrate the market's attention and can precipitate sharp moves. Second, central bank policy and fiscal posture remain a backdrop. When inflation is elevated, but the Fed is forced to inject liquidity to preserve functioning rather than to ease markets, you end up with a toxic mix of higher nominal prices and deteriorating market confidence. Third, the geopolitics of settlement and the diversification of official holdings are now central to the thesis. The willingness of some buyers, whether sovereign or institutional, to use alternative clearing venues or to take physical custody outside legacy Western exchanges weakens the monopoly of the old settlement system and enhances the strategic value of physical metal. That trend is not hypothetical. It is visible in public central bank purchases, rising allocation to allocated bullion products, and the growing prominence of non-Western exchanges as settlement hubs. Fourth, supply-side realities in silver and gold amplify these forces. Silver's industrial demand profile, combined with concentrated above-ground silver and the concentrated nature of deliverable inventories, means that tightness shows up faster and with greater price sensitivity than in many other commodities. Gold faces its own constraints: hoarding behavior, allocated ETF flows, and central bank purchases can reduce available lease and lending inventories and compress the paper-to-physical spread. From a risk-reward standpoint, these structural squeezes create asymmetric upside for physically secured holders. Finally, prudent investors should think in terms of both position sizing and execution, favor allocated, auditable, and segregated custody where possible, prefer counterparties that can demonstrate true deliverable inventories, and be mindful of timing around contract expirations and known delivery windows. There are no guarantees. Markets can remain irrational longer than anticipated, but the combination of eroding trust, concentrated delivery risk, and meaningful sovereign demand produces a compelling case for increasing exposure to physically backed metals as part of a diversified, long-term portfolio. Thanks for watching. If you found this helpful, please like, subscribe, and ring the bell so you don't miss more expert analysis about the precious metals market, resource sector, and overall global economy. See you in the next one.